Don't count on the Federal Reserve to fuel the next leg of the gold rally. That was the clear message to investors on May 7th when the Federal Open Market Committee wrapped up its latest meeting. In the past, traders could reliably bank on rate cuts to boost gold prices, but that playbook appears outdated. Today's market is increasingly responding to real-world disruptions rather than monetary policy. And in the short term, we may be seeing the early signs of a shift away from policy-driven pricing and toward a gold market increasingly shaped by physical demand. If you love hearing the stories no one is telling about gold and silver, then subscribing to our channel is a small but meaningful way to ensure these videos continue. Thank you. The relationship between interest rates and gold is like a book with a favorite chapter dog-eared. We're very familiar with the story and can almost recite what will happen word for word. When the Federal Reserve lowers the Fed funds rate, gold prices perform better. When they're raised, gold prices perform worse. Sometimes it doesn't matter if the Fed does anything at all. They need only hint at a change in direction to either benefit or hinder spot prices. Gold investors don't live in an isolated vacuum. If gold's competitors like US Treasuries suddenly provide a better yield due to rising rates, then capital finds its home in T-bills and demand for gold wanes. But if interest rates decline and inflation remains high, perhaps sending real rates negative, interest in gold climbs. Armed with this knowledge, gold investors bend their ear when the Federal Reserve meets, and the last meeting on May 7th revealed what should have been an obvious truth. The Fed has adopted a cautious stance. Prior to this meeting, the CME Group's Fed Watch tool was predicting a greater than 50% chance of a quarter basis point rate cut in June. The market really should have known better. After May 7th, the odds declined to just 16%, and even that seems optimistic. At the root of the Federal Reserve's hesitation is the cloud of uncertainty lingering over global trade. The Fed has a dual mandate: to maximize employment and minimize inflation. After the pandemic, stimulus checks created the worst inflation the United States has seen in decades, alongside a historically tight labor market. The focus was squarely on bringing inflation back to 2%. To this day, we have yet to meet that goal, in spite of years of elevated rates, though we are getting closer. Meanwhile, our economy hovers near maximum employment. With inflation still running hot and recent readings showing a month-over-month reversal, one would be tempted to question why the market expected a full percentage point of rate cuts this year at all. And then there are the tariffs. Tariffs could raise inflation and unemployment in one fell swoop, forcing the Fed to choose which side of the dual mandate they react to. In a worst-case scenario for gold investors, the Fed could choose to fight rising inflation with an additional hike. After FOMC meetings, Fed Chair Jerome Powell takes questions from the press. A reporter from Fox Business asked the one question no one wanted to ask. He said, "We have the CPI report that showed month over month the first increase in inflation in about 3 years. The jobs report, solid. At the same time, we have the new tariffs that we're living under. Given this, should the Federal Reserve be cutting rates at all this year?" Powell paused before responding, "It depends," and further adding that we are going to need to see how this evolves. Repeatedly throughout the press conference, Powell referred to the uncertainty that tariffs are causing as the primary reason for delayed action. This is a completely logical course of action and highlights the absurdity of market expectations. As part of the ongoing negotiations, the current administration has paused tariffs for 90 days. That pause ends on July 8th, after which we may have some resolution or we may have additional uncertainty. But one thing is guaranteed: we won't know in June, and that means the odds of a rate cut are long indeed. And yet, gold doesn't seem to care. The rally that began on rate cut speculation has taken on a life of its own, driven not by monetary easing but by physical demand, geopolitical stress, and widening cracks between the paper price of gold and the physical bullion trade. Earlier this year, tariffs created chaos in the gold market when it was unclear whether bullion would be exempt. Demand surged as institutions tried to front-run the risk of new costs. A lucrative arbitrage emerged. Banks and exchanges airlifted tons of gold from London to the US, paying steep premiums to get it onshore before any new tariffs hit. A 10% duty on gold would be catastrophic, and the market responded accordingly. By late April, the tension spilled over into price action. On April 22nd, gold crossed the $3,500 threshold for the first time in history and immediately collapsed. Headlines around the world focused on the spectacle, a nearly 10% drop in 2 days. But beneath the surface, something more meaningful was playing out. April 22nd wasn't just about price volatility, it was about what was driving that volatility. We've seen this before in 2008 and 2020, moments when real-world demand overwhelms the paper trade. Premiums widen, liquidity thins, futures become less of a forecast and more of a reflection of lag. This isn't a technical blip, it was a demand signal. The last rate cut was in December 2024, and since then the Fed has stood still, and yet gold hasn't. Market expectations for a rate cut at the July Fed meeting have fallen from 2 to less than 1. And still, gold has held firm above $3,200, well above the $2,600 range we saw before the last cut in December. The daily correlation between rate cut odds and gold prices? Minus 0.36. That's not just weak, it's statistically meaningless. What we are seeing is a potential decoupling. Tariffs, physical flows, and real-world scarcity are driving price more than monetary policy. Gold isn't waiting on Powell, it's responding to pressures the Fed can't touch. All of this points to a shift in how gold is moving. Rate cuts may have kicked off the rally, but they no longer appear to be the dominant force. Instead, we are seeing increasing influence from physical demand and global trade dynamics, factors the Federal Reserve doesn't control. Whether this is a short-term anomaly or part of a longer-term change remains to be seen. But for now, it's a reminder that gold doesn't always follow the script, and sometimes the real story is playing out in places most investors aren't looking. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.